Hi folks, David Waring here again with InformedTrades.com. In yesterday's lesson we took a look into technical analysis and took a little very brief look into the different ways that traders analyze the markets. In today's lesson we're going to take a short look into the history of technical analysis and something which is known as Dow Theory. Most consider the father of technical analysis to be Charles Dow, founder of Dow Jones and Company, which of course publishes the Wall Street Journal. Around 1900, Dow was analyzing the movements of the Dow Jones Industrial Average and the Dow Jones Transportation Index, and he noticed that these two indexes tend to move in predictable ways over time, or similar ways over time. And he outlined his findings in a series of papers which were expanded upon by other traders in the years that follow, and these papers became known as Dow Theory. Although Dow Theory was written over 100 years ago, most of the basic principles which are outlined in those papers, most traders feel are still relevant today. Also, although Dow focused his work on the Dow Jones Industrial Average and the Dow Jones Transportation Index, most traders also feel that these basic principles are also relevant to any market, not just the stock market, and in particular those indexes. So in today's lesson, we're going to take a look at the first three tenets of Dow Theory. There's 6 of them. And then we're going to finish up our conversation on Dow Theory in tomorrow's lesson by looking at the last 3. Okay, so let's get started.
Okay, so the first tenet of Dow Theory is that the markets have 3 trends. The first type of trend that Dow defined was what's known as an uptrend. You can see an example of an uptrend there, or a time when successive rallies in the security price close at levels higher than those achieved in previous rallies, and when lows occur at levels higher than previous lows, is how Dow defined that. Opposite of an uptrend is a downtrend, which is the second type of trend, and that's basically defined as when a market makes successive lower lows and lower highs. Pretty basic there. The next type of trend is a correction, and basically Dow defined this as a move after the market makes a move sharply in one direction, then the market recedes in the opposite direction before continuing in its original direction. So you can see here market in an uptrend, then a correction, and then continuation of the original uptrend. It's a good example of a correction there. Tenet 2 is that trends have 3 phases, and probably the best example of this is a longer-term chart of the NASDAQ, and showing in the run-up into 2000. You can see the accumulation phase here, which is the first phase, and when the expert traders, so to speak, are actively taking positions which are against the majority of traders. And then the next phase being the public participation phase, where the public at large catches on to what the experts, so to speak, know, and begin trading in the same direction. A lot of times you see a pretty rapid price increase during this time. And then the last phase being the excess phase, and this is where rampant speculation catches on, and basically the smart money people, so to speak, start exiting their trades before the eventual reversal of the trend. And you can see that there, and it's a good example of the NASDAQ at the excess phase. If you remember, people were just at the end of the trend, were basically buying just in the hopes of selling to someone else at a higher price. Tenet 3 is that the markets discount all news, and this basically means that once news is released, it's already reflected it's reflected very quickly in the price of an asset. So you can't, what Dow is saying here is, you can't really beat the market by looking at fundamental factors, only by technical factors. And this is in line with the efficient market hypothesis, which is listed there, and technicians or people that use technical analysis often use this as an argument in favor of their type of analysis, because if this is true, the efficient market hypothesis is true, then that really means you can't beat the market using fundamental analysis, so technical analysis would be the only way that you could. So that's our lesson for today. Hopefully you have a good understanding of the first 3 tenets of Dow Theory, and I hope you join us tomorrow for the second 3 tenets, which we're going to go over in lesson 3. As always, if you have any questions, please feel free to visit us at InformedTrades.com or email me at david@InformedTrades.com, and have a great day.